Good. We're rolling. Episode 8.
Ready to roll.
So we get on. We go in a lot of directions.
Yes. It's a broad topic, for sure.
Cool. Sweet. All right, man. I got the train ready in case we need it.
We may. Hello, everyone, and welcome to the Lending Podcast. Once again, coming to you from Austin, Texas. We are your hosts. This is Jeff Jones.
Hello.
And I'm John Burnham. Thanks for being with us today. What are we going to talk about, Jeff?
Episode 8, the Lending Podcast. We are talking about investment properties.
Okay.
And there's a lot of different directions we can go in this, but a lot of it for us, I think, is going to be defining for those people that are looking to get into it for the first time. You know, we do have friends that are seasoned investors, and a lot of times they're putting together like maybe even portfolio loans, and you know they have over 10 mortgages already, and so it creates a different kind of program that we can put together for you. But for the most part, we're talking people that are maybe doing their first or second investment property.
That's right. And for a lot of our buyers, they're looking to buy a multifamily property as their first property. So let's dive into that real quick. So I have a client right now who's never bought a home before, and they want to buy a duplex, and they want to live in one side and rent the other side out. It's a great way to get involved in investment real estate. However, it's considered owner occupied, right? And so it's a great time right now because there are some new construction opportunities out there for areas where you can purchase a multifamily. 2 to 4 units are considered multifamily in the residential space. When you get over 5 units on one property, that's considered commercial. So if we say multifamily, we're talking about 1 to 4 units, well, 2 to 4 units rather. Single family, of course, is 1 unit. And so for a duplex or the unicorn triplex, I've only financed one triplex in 22 years, by the way.
3 units.
So 3 units.
Yeah.
If you find one of those, let us know. I want to.
Not many.
I want to see that in person. And then a fourplex, of course. So 2 to 4 units is multifamily. And when you're owner occupying one of those units, you can put as little as 5% down now.
5% if you're living in one of the units.
That's right.
That's phenomenal. So and that used to not be that way.
No, it was 15. Well, no, it was 15% down for conventional.
So this is new.
That's right. Now, FHA has always been 3.5% down. So you can buy a multifamily 3.5% down FHA. That still exists. The challenge sometimes with FHA is the costs are a little higher, and we can dive into that on a different episode.
Yeah, inspection requirements are higher too.
They are.
Yeah.
Depending on the age of the property, it could be a tricky
That can be very tricky.
So, yeah.
Before we go further, if people are looking at multi-family units and they're seeing things that are 5, 6, 7 units, you know, it's not something to be afraid of, right? Because commercial loans are very due. We do them here as well.
That's right.
And a lot of times they're somewhat can be easier. And pricing isn't too much different.
Agreed.
So if you're ever entering that kind of search and it pops up, feel free to talk to your lender because that can be navigated pretty well as well.
That's a good point. Yeah. So commercial would be considered 5 to 8 units, and that would be like a small apartment complex, something like that. Over 8 units, that's a little different. It's apartment type loans and portfolio loans with local banks. Certainly, we can help facilitate those.
So that's good. So 1 to 4, that can be, you know, residential and personal loan. 5 to 7,
5 to 8,
5 to 8, commercial. And then over that is apartments, and it's a whole different animal.
It is.
Okay.
It is.
Good.
So when we dive into like what is an investment property, well, first of all real estate is an investment, right? All real estate's investment, whether it's your personal home or whether it's actually a non-occupied property or perhaps a second home. It's all investment real estate to an extent because it is an asset that you're paying on over time and building equity, right? So specifically for this episode, we're talking about buying non-owner occupied properties. One of those facets, however, is living in part of the unit if you're buying multifamily, right? So 2 to 4 units, you can live in one side, rent the other side out. It's a great way to get involved in owning real estate. You're on site for property management, essentially. You know what's going on with your neighbors next door. So for a lot of our first-time investors, it's a good way to get into the market, dip a toe in the water. For our other clients out there that you own real estate perhaps, and you've had a run up in equity, and you're looking at what do I do? How do I take advantage of this equity? How do I buy my next property and leverage the asset that I already have? And so we talk about that a lot with clients, accessing the equity in your current property, using that as a down payment. And that's one of the ways to get the down payment for investment real estate, because there's a lot of lending requirements when it comes
Right.
to buying an investment property. So let's kind of dive into maybe what are some of the qualifications. What do you have to do different when you're buying an investment property versus buying an owner occupied property, right? So there's
Right.
owner occupied, second homes, and investment. Maybe touch a little bit on what the differences are in those.
Yeah, a lot of it is the the concept of having reserves. That's like the super simple concept of, for an investment property, you are relying on getting cash flow, you know, with the renters that are there. And when that occupancy isn't at full, when it's not 100%, what are you counting it at? When you're buying your single family home for yourself, it's always going to be 100% occupied because you're in it. It's your home, it's your homestead. When you are buying investment property, you're having other people you're relying on. A lot of times we have to count that at 75%, which forces us to have a reserve requirement for you to cover gaps of rent. And different programs will have different reserve requirements. Some will be 6 months, some will be 12, and it might be a different scenario for each program.
You're exactly right. So the qualifications for investment
Right.
is we're taking your current mortgage monthly payment, your owner occupied payment, and then we're adding the proposed liability for your investment purchase, right?
Right.
So whatever your payment's going to be on your new investment property. And then, like you said, we're taking 75% of the
The
rental
income.
income
Hmm.
that we usually get from the appraisal. The appraiser will do an analysis, a rental analysis on the property, and tell us what the market rents are. And then
Right.
we take 75% roughly of that number, or we can use a lease agreement in some cases. We show the market rent is X, and then we'll take
Yeah.
75% of that lease agreement. That can help you offset that mortgage on paper. So it's not as difficult to qualify on paper for an investment property as you would think.
Right.
Because if your mortgage payment is going to be $2,000, but the rental income is $2,000, then we're using 1,500 of that, right? 75% of 2,000. So you have this small negative on paper. It's like $500. That's like a car payment, right? So
Right.
it's not like you're really trying to qualify for a full 2,000 extra dollars a month on paper. Even though the goal is not to break even, the goal is to cash flow,
Right.
which we'll talk a little bit more about
Yes.
why is a good investment, right? To cash flow and have income coming in from this asset.
Right. And so the debt to income calculation is taking into account the rents you're going to be receiving once you own that property. If there is a 2-year history of past rents, that helps justify what we can count towards what you're going to get. The appraisal will also do their own calculation for what rents we're going to get as well. And also, if you have currently signed leases, that can count and factor in and weigh in to what those incomes will be. So it's kind of a three-piece income view on what that property can bring in for
Yes, and
you.
that you touched on something, which is if you've had rental property and you've been claiming that rental income on your Schedule E on your tax
Right.
return, we're looking at that rental income calculation and using the actual rental income from your tax return, right? If you're a first time investor, you obviously don't have
Don't have
rental
the
income,
history.
don't have the history. So
Right.
then we're using the appraisal or we're using the market rent from the lease. And so those are questions that we get. How can we use the lease agreement? Uh, can we use the rental income if I move out of my current house and I want to buy another home? And that's called a departing residence, right?
Yes.
Where you own a home now
Okay.
and you
Yep.
want to buy a new owner occupied home and you're leaving your current home and you're going to rent it. How do we calculate that rental income? And that's that equation that you just touched on, which is the 75% of the lease agreement for the market rent. And so there are a couple of different ways to look at those rental calculations. Some lenders will only use the appraisal. Some lenders will use the lease agreement, 75%. So it depends on the program, and it depends obviously on your history and whether or not you've had rental. If you've been a landlord, you've proven that
Yeah.
you've been a landlord or not.
And in general, to circle back, because this could be a great scenario for a lot of people, is you own your home, you want to buy your next home, and then rent your current one out because you love your rate you're at. You're like, man, I'm only paying this much a month on this home. It would be great as a rental income, possibly, and add cash flow. So what you're going to do, you've never rented that property out, so you don't have a history of renting out your own home because you're in it. And so what do you need to be able to count the rent you're going to get? And that is basically a signed lease agreement. So we're generally speaking for our Texas state and for what programs we have offered. And most of them, as long as you have a established lease agreement for the person coming in and the deposit,
Proof of deposit. That's
proof
right.
of deposit,
Hmm.
then we could count that, you know, to offset your mortgage on your departing house.
That's right. And I think one of the best ways to start stacking your real estate, and we call this rapid acquisition if you're doing it quickly, maybe in a year or two. But over time, when you're building your portfolio, you are buying your next home owner occupied, and you're renting out the one that you're leaving, and you can do that over time.
Right.
You're when you're buying a property owner occupied, you're essentially saying, "I'm going to live in this property for the next 12 months." That's kind of the commitment you're making to the bank. You're signing those owner occupied documents
Yeah.
with the intention of living there for at least a year.
And that's your mailing address is changed to that, your driver's license is changed to that, it's your homestead, right?
That's right. And that next purchase is a lower down payment than if you were buying a straight up investment property.
Right.
So let's talk about the differences. If you're keeping your current home, you're living in your current home, and then you want to buy an investment property, what is the down payment needed there? And usually that starts at 15% down. Most common is 20 to 25%. Little known fact though, you don't actually have to put 15, or you don't have to put 20% down to buy an investment property. You can put 15. And that's probably 1% of the people out there know that. Now, the costs of putting 15% down on an investment property is astronomical. Like you're probably not going to want to do that when you see how much it's going to cost you
Right.
in fees. So, does the program exist? Yes. Is it the best loan? Probably not. And so, again, we'll dissect that and we'll go through the loan options with you. And ideally, instead of paying fees and origination and discount charges because the loan is more expensive, putting less down,
Right.
you would take that cash, put it more towards the equity. So you're having 20% equity, 25% equity to start off with, and you're going to cash flow better.
Right.
So it depends on the goal of the property. Is this property that you're buying designed to cash flow, or is this property that you're buying a real estate play because you're getting value and there's a motivated seller involved and you're getting it at a discount and you're trying to get in for less cash because you need to preserve cash that you have. So all those, the why behind it is so important. And
Mm-hmm.
so really asking questions and figuring out what your goals are is critical.
I think that's huge, and I know we've talked a little bit on other episodes about working with financial advisors for your plan, and if if you're doing investment properties, you definitely want a financial advisor helping you out as well. If you don't have one, talk to your lender, and if you guys have a plan together, there might be an avenue to also bring a financial advisor into that conversation, so that your lender and your financial advisor can get on the same page about like what kind of short term, long term goals you have. And so that can dictate our programs as well of what we set you up with. Um,
For sure.
and if you want to talk about just different, cash flow options, because a lot of people get into this for cash flow. They don't want to just put their money into the stock market and
That's
put it
right.
into a big brokerage account and just wait for that to appreciate in value. But they want to put it into something that's real, that they can touch and feel, and will bring them a monthly income every month.
That's right.
So cash flow is a big deal.
So a newer concept that we're learning about is something called midterm rentals. So I'm going to break down the different kinds of
Okay.
tenants that you may have in your investment property. So there's short-term rentals, which most of us know, typically Airbnb, VRBO, nightly rentals, right?
And the slang is STR,
STR, right?
short
Short-term
term
rentals.
rental.
That's right. And then now you have something breaking into the market called midterm rentals. And this is really growing in popularity because there are many people out there that need a corporate rental and or traveling medical professionals,
Right.
or there's been an insurance claim and your insurance company is moving this family from your current home that's now being renovated because you had a pipe burst and they're putting you up for 30, 60, 90 days. So a midterm rental is considered 30 days and longer. And that is a way to not get around the short-term rental requirements, but it is a different type of tenant that's in your property.
So
So
it's
it doesn't
month to month kind of scenario.
exactly, and it doesn't fall under the short-term rental, which requires licensing in many cities
Right.
for STRs, right? So those midterm rentals what I've learned now about these is that you may only have the property rented for 7 or 8 months out of the year. You may
Right.
have bigger gaps, but you're getting 2 to 3 times on a monthly basis what you would normally get for rent, because who's paying that rent? Again, it's a corporate rental, maybe an insurance company. So the checks are bigger, and maybe you're getting 60 to 70% occupancy versus trying to get 100% occupancy. And then, of course, we have the long-term renters, which would be 12-month, typically 12 to 24-month leases, and you put a tenant in there and hope that they take really good care of the property and stay
Right.
there and pay on time and
Yeah.
leave it really nice when they leave. And
Right.
all the battles that I've had having former rental properties with really poor tenants. So do screen your tenants really well. I will say that.
And a good thing is those cash flow models of long-term rentals has always been kind of the standard of cash flow models. But in this day and age, over the last, less than 10 years, the financial modeling for investment property has to take into account now just not long, no longer long term, but those midterms, the MTRs, and the short terms, the STRs. So a lot of modeling for if I'm going to buy this investment property, there's some great resources out there of like what's your break even going to be, what's your cash flow going to be on this property. Some websites you can just type in an address and it'll give you like a financial report on it. There's a lot of great resources out there. But if you're going to be doing those different cash flows, just making sure that that scenario is represented in your prospectus set of buying that property,
That's right. And the property may dictate which kind of model.
especially location, right?
Absolutely.
Right.
So a lot of times we'll have an investor that starts out and they think, okay, I want to buy a single family house and I want to put a long term tenant in there. And the truth of the matter is, with some of the rising costs and interest rates where they are, and property taxes continuing to rise, home insurance has gone up in the last couple of years with these bigger insurance companies.
Right.
So those payments are higher than they were, of course, a few years ago. And rents, although they've risen, maybe haven't risen to the level that payments have risen. So depending on the area, I've heard from a lot of our real estate professionals, it can be challenging to buy a property and cash flow at day one with a long-term tenant in there.
Right.
Although there is value in the marketplace, you can find properties that perhaps have a motivated seller,
Yeah.
find properties in areas that have lower tax rates, find newer properties that maybe the insurance costs are less.
Yeah.
And so you really need a professional, real estate professional on your team who is walking you through all the different possibilities, and a lending team that can help you put the picture together, whether this is a short-term rental potential. We know if you're buying a condo in downtown Austin, it's most likely probably a short-term rental if it's eligible for that, right? If you're buying a new home in a brand new subdivision, it may be a really good midterm rental, because it will garner 3 or 4 times the monthly rate
And have
in
desirable amenities and all
have
that good stuff.
great amenities,
Right.
right? And so, or if it's a long-term rental, so you really have to look at the different scenarios for each loan requirement. How much are you putting down? What's the total payment going to be?
Right.
What's the potential rent going to be? And then take a deeper dive on how do you want to get into the real estate game? What is your level of
Yeah.
comfort when it comes to risk? Right? We have some very risky investors out there that we work with. They're willing to take the risk because they see it as a very long-term play. They're not worried about maybe losing money the first year or two because they're really looking at the appreciation game. Then you have other investors that say, absolutely, day one, I need to cash flow, and totally understand that. So we want to help you where you're at.
And there are programs that are specifically for lending that are cash flow sensitive.
That's right.
So if we could talk about those. Those are generally not a traditional kind of mortgage. We call them a non-qualified mortgage. So what I'm speaking to is bank statement loans, or what we call DSCR, debt service coverage ratio loans. So why would people choose those compared to like a conforming loan?
DSCR loans are awesome. I mean,
Yes.
quite frankly, we are not going to ask for tax returns. We're not going to ask for paycheck stubs. We're not going to ask for your personal income at all. We're going to qualify you for a DSCR loan based solely on the payment and the proposed rent for the property.
Right.
And you can own dozens of properties and still be eligible to purchase a home based on this DSCR program.
So the monthly rent roll that you're going to be getting has to cover the cost of the mortgage.
That's right. We call that a
And
one-to-one ratio.
so that's property and our principal, interest, taxes, association dues as well, right?
Yes. Yeah. Principal, interest, taxes, insurance, and association
Right.
dues. Yes.
Good.
And so let's say that payment on your new property you're going to buy is 2,500, and
Right.
the rent in that area is 3,000. That's over a 1-to-1 ratio,
And
and
that's what
that's
they're usually looking for,
mhm,
right? So they will use a ratio term called like 1.0 will be the start. And they're usually looking for 1.5 to get you a better rate. So it's covering over 50% over the cost. But even just a break even might be able to be eligible for a DSCR loan.
that's right. And for some of those programs to get better terms, if you're in a cash position to do so, perhaps you put a larger down payment. So you put a larger
Bring
down
in,
payment, brings the payment down,
right,
helps the debt coverage ratio. The lender looks at that as lower risk. You
right,
get better terms. And you can always come back out, maybe tap into that equity down the line, do a
right.
refinance when values go up and perhaps rates come down. You could go back in, grab some of that equity, and do it again.
Yeah.
So we love the DSCR program. You can do it with bank statements as well. It's not DSCR. If you use bank statements to qualify, we just qualify you based on your income from your bank statements and give you a debt to income ratio based on your bank
Yeah.
statement deposits.
And the bank statements are looking for they're taking the statement and taking the ins and outs and creating a cash flow scenario.
That's
That
right.
gives us a baseline of a 12-month statement. So we do, January statement, February statement, March, all the way
Mm-hmm.
through a full 12 months, and that gives us a year calculation.
That's right. And it's great for our self-employed clients that
Yeah.
have fluctuating income, 1099 individuals. If you're a consultant, your income comes in. We have a client right now that his only income is K1 income, right? It's self-employment income. K1, he's a partner in a trading firm, and so stock trading. And so we just see some unique scenarios
Right.
for our W-2 paycheck stub clients. The bank statement program is probably not for you. You're going to be better off going through a conventional route,
Right.
right? And so those conventional loans versus these non-qualified mortgages that you touched on, they have different interest rates, but right now in the investment world, they're pretty
They're
similar.
very close. They're closer than we've seen them in a very long time. So it's kind of an apples to apples kind of term of which one really you're going to qualify for better. And then at the end of the day, are the terms better?
That's
And
right.
that's what we're looking at for your loan.
Yeah.
Terms meaning length of the loan, payment on your loan, and your pricing on it, your cost on it. So um, this was good. I still think this can be a very good time for people to buy investment property, even
Absolutely.
though it's March 2024, just to date this podcast. And a lot of what we're hearing out there in the conversation, in the media, and social is people have been putting a big hold on investment property buying. But what are the benefits of buying? What are we seeing as the pluses for buying right now?
Oh,
Why
there's
is
a ton because you have so many sellers that have had a run up in equity
okay,
and they know they're sitting on a good chunk. And yes, they want to maximize that. There's
right?
very few sellers that are willing to just give their properties away. We know that.
Hmm.
However, needs and wants of a seller are completely different sometimes. So they want to sell yesterday for cash full price.
Yeah,
They need to sell tomorrow at X price to get Y dollars. And so it's really important that when you're putting your model together and figuring out, number one, what kind of loan program best suits you. Is it a DSCR loan? Is it a bank statements loan? Is it a conventional loan? What kind of cash are we working with? Are we looking at buying owner occupied? Are we looking at buying investment? Again, the down payment is the big difference. Credit score, of course, we're always looking. Every conventional loan minimum is a 620, but when it comes to investment real estate, you really want to be over a 680.
yeah.
And so 700 plus would be ideal because the interest rates are lower, payments lower, cash flow is better. So all those pieces of the puzzle work together. But right now, you've got value in the marketplace. There are properties, there are sellers who are willing to negotiate. They are willing to make a little less, perhaps, than what they would have made a couple of years ago. And
Right.
we just have to find them at the right time. It is a bit of a numbers game right now.
It is, and what we're seeing, and there's been some recent news stories too about price drops of some of these properties because they are usually a higher price point when you get multiple units, or almost always a higher price point.
Right. Like two to
But
four units, you need,
yes,
yeah.
but as the higher dollar price points, we're seeing kind of a lag of sales on those, and so sometimes that lag is showing a reduction in price. So some people are thinking about it this way of like, if I can buy the property essentially on sale, I'm buying it below really what I truly believe the value to be and will be in another 12 months. If you want to turn around and sell it, then you're buying it on sale right now. So this might be a great time to find a property that you think is just a great price point, purchase price. And then the rates you have, you might be able to change down the road on a refinance, in a year or two. So right now, I think one of the huge pluses is you're getting a great deal on the price.
Absolutely. And when it comes to coming up with the cash, right now our investment accounts, the stock portfolios out there have been doing pretty well. So I
Right.
wouldn't grab the money from that source necessarily. If you've got money sitting in a brokerage account, let it continue to grow for you.
Right.
Consider taking it from your existing home as a home equity loan and get your 20 to 25% down payment for your investment property from your current house. It's going to continue to appreciate, and you're basically borrowing that equity to then go leverage it and purchase a really good deal on real estate. And then
Mm-hmm.
you're double leveraging yourself as your real estate asset is growing. And if we say that real estate historically has averaged 3 to 5% per year appreciation, there's going to be years where it's 2%. There's going to be years where it's 9%. We get that. There's been a couple of only 6 times in the most recent 40-year span has real estate gone down. 34 years of positive, 6 years of negative. So that's unbelievable stat, right? That's
Right.
all the way back to like 1980.
Right.
And so, yes, there's been some pockets in there where real estate has gone down, but overall, it will continue to appreciate. And so, we always say it's about time in the market, not timing the market. And we're not trying to get
That's
in,
good.
get out. We want to get in, stay in, and really find a blue chip
Right.
property like a blue chip stock, right? Buy it, hold it, and then when the opportunity arises, if it makes sense, you're selling it, you're parlaying it into the next one, or you're continuing to compound, add to your portfolio. And we have clients that have over 20 real estate investment properties.
Yeah. And and sometimes it's not even their full-time job.
Right.
They
Right.
just
Part.
know that it's a good deal for them and they're able to manage all that really well. And so it brings a lot of cash flow.
That's right. And you're not able to get to 20 until you get to
Yeah.
one. You have to get
Right.
to one first.
Right.
That's right. So,
So if
that's a
you need
business.
help getting to one, we'd be happy to help you out here in Texas. We are based here in Austin, and we appreciate you tuning into the Lending Podcast. Anything else we got, or are we closing this one
I
out?
think that's a wrap for today.
And
We-
we got to mention though, your first purchase of
oh,
house was what kind of
I bought 5 investment
five
properties. My wife
investment
and I
before you
bought
bought your
5
primary home? You bought 5 investment
before
properties.
we ever bought our house.
So we're a
Yes.
little passionate about this topic.
That's right. We do love our investment real estate, and we there's so many other ways we could take it, right?
Yeah.
With second homes and turning them into Airbnbs and the commercial property aspect. So hopefully that touched on some basics on a high level for you guys today, and we're really appreciative of you tuning in.
All right. Have a good day. Like, subscribe, share to the Lending Podcast. We appreciate you. Bye.
Take care. See you soon.